All right. Looks like we are live. Welcome everybody to Live Valuation. I'm Midas Moriarty. Just give me one moment to make sure everything is up and running everywhere. Okay, good. So today we're going to be taking a look at Micron, ticker MU, which just put out their 10K a couple days ago. Fourth quarter results complete, which this one's definitely been on my radar for a very long time. Valued them before, but much earlier in my own personal learning process. So frankly, I probably didn't really know what I was doing at the time, and probably missing out on a lot of key factors. But I was interested, especially after hearing of their capital allocation plan. They're apparently starting a quarterly dividend, relatively small, and continuing with share repurchases that they've kind of been on and off for several years. But whenever there's a good capital return plan announced, that definitely perks my ears. So I figure we'll take a look at them because I kind of always wanted to have a player in the memory space. Just a question of picking it up at the right time in the cycle, which this may not be, but we'll take a look and we'll find out. But either way, I have their statements already in here. Did all the earlier prep work, got their debt listed out. Weighted average maturity for years of about 5 years. Weighted average interest rate of 3.47%, about $7.3 billion in book debt. We'll see what the market value comes up after all the other factors put in. Unlevered weighted beta of about 1.07 based off of their industry distributions, which we also have sales to capital expectations of 1.26 and 15.27% respectively, which is a pretty good combination, but we'll see. The industry averages for the sales to capital ratio and the margins for this particular one won't make as much sense as the beta because I use the same process to essentially come up with all three. But if I have to choose which one to make it lean towards making it more sense, I work towards the beta making more sense. And because I don't really care as much what the industry averages for sales to capital ratio and margins are, that's just useful sometimes if it can be, but it doesn't have to be useful. So the point is that may or may not mean anything. We'll see what their actual margins sales to capital ratio looks like after we do all their financial statements, which I have already lined up and set to go. I already put their share counts and RSUs in here as well. So basically we just need to do financial statements, which I will start playing their fourth quarter call. I have already geared up here, as well as we'll listen to their analyst call after that while I'm doing this.
Good afternoon. My name is Latif, and I will be your conference facilitator today. At this time, I would like to welcome everyone to Micron's fourth quarter 2021 financial release conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer period. If you would like to ask a question during this time, please press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. In order to allow as many analysts to ask a question as possible, please limit yourself to one question. Thank you. It is now my pleasure to turn the floor over to your host, Farhan Ahmad, Vice President of Investor Relations. You may begin your conference.
Thank you, and welcome to Micron Technology's fiscal fourth quarter 2021 financial conference call. On the call with me today are Sanjay Mehrotra, President and CEO, and Dave Zinsner, Chief Financial Officer. Today's call will be approximately 60 minutes in length. This call, including the audio and slides, is also being webcast from our investor relations website at investors.micron.com. In addition, our website contains earnings press release and the prepared remarks filed a short while ago. Today's discussion of financial results will be presented on a non-GAAP financial basis unless otherwise specified. A reconciliation of GAAP to non-GAAP financial measures may be found on our website. As a reminder, a webcast replay will be available on our website later today. We encourage you to monitor our website at micron.com throughout the quarter for the most current information on the company, including information on the various financial conferences that we will be attending. You can follow us on Twitter at MicronTech. As a reminder, the matters we will be discussing today include forward-looking statements. These forward-looking statements are subject to risks and uncertainties that may cause actual results to differ materially from the statements made today. We refer you to the documents we filed with the SEC, specifically our most recent Form 10-K and 10-Q, for a discussion of the risks that may affect our future results. Although we believe that the expectations reflected in the forward-looking statements are reasonable, we cannot guarantee future results, level of activity, performance, or achievements. We are under no duty to update any of the forward-looking statements after today's date to conform these statements to actual results. I will now turn the call over to Sanjay.
Thank you, Farhan. Good afternoon, everyone. We delivered outstanding results in fiscal Q4, achieving robust profitability and the second highest quarterly revenue in Micron's history. Strong execution drove healthy results across segments, including record quarterly revenue in NAND as well as in our embedded business. Fiscal 2021 was a year of many records for Micron. We achieved our highest ever mobile revenue, driven by all-time high managed NAND revenue and MCP mix. Our embedded business had a tremendous record-breaking year, with auto and industrial businesses both at substantial new highs. And our Crucial branded consumer business and overall QLC mix in NAND all hit records in fiscal 2021. Through the year, we successfully navigated multiple obstacles brought on by the pandemic and reached several key milestones. For the first time in Micron's history, we established technology leadership concurrently in both DRAM and NAND. Micron's 1-alpha DRAM and 176-layer NAND are the industry's most advanced nodes in high-volume production. And we further strengthened our product leadership by becoming first to introduce LP5X DRAM and uMCP5 managed NAND in mobile, and the industry's first functional safety-capable LP5 for automotive applications. The secular demand for memory and storage, combined with Micron's focused execution and our rock-solid balance sheet, position us well to deliver strong financial performance and create significant shareholder value in fiscal 2022 and beyond. Demonstrating our confidence in our business trajectory, we initiated a quarterly dividend that we aim to grow over time. Memory is at the leading edge of semiconductor manufacturing, and Micron has leadership in both DRAM and NAND technology. This quarter, we reached mature yields in our ramp of 1-alpha DRAM and 176-layer NAND 20% to 30% faster than prior nodes, and delivered performance and feature improvements that will help unleash customer innovation. We believe we are several quarters ahead of the industry in deployment of these process technologies. Additionally, through deeper customer collaboration, we have further accelerated the time to market for value-added solutions built using these nodes. 1-alpha and 1Z DRAM nodes combined now represent the majority of our DRAM bit production, driven by strong growth of 1-alpha production. And by the end of the calendar year, 176-layer NAND will make up the majority of our NAND bit production. Looking beyond 1-alpha DRAM and 176-layer NAND, we are investing to sustain scaling in both technologies for the next decade. Adding momentum to our years of R&D in EUV, we recently took delivery of the industry's latest EUV system, NXE 3600, at our Boise headquarters, where we operate one of the world's most advanced centers for semiconductor research and development. The delivery of this tool is an important milestone toward our previously disclosed plan of implementing EUV in high-volume manufacturing in the 2024 timeframe. We expect that the integration of EUV with our existing multi-patterning immersion lithography expertise will help us maintain DRAM technology leadership for many years to come. In addition to being a technology leader and an innovation partner, we are uniquely positioned as a strategic supplier to our customers. Micron is the only US-based memory company, and our strong global manufacturing network provides us with a diversified source of supply, which has become increasingly critical to ensure that we continue to deliver product reliably to our customers. The advantages of this unique position have been proven throughout the past 18 months as we have successfully navigated the challenges of COVID-19 across our global manufacturing network while maintaining continuity of supply to our customers. Now let us review our end markets. The demand for memory and storage has evolved dramatically from the PC-centric era. Today, demand for memory and storage is driven from diversified end markets that extend from data center to the intelligent edge and to a growing diversity of user devices. As a result of growing memory and storage content per device, DRAM and NAND now account for an ever-increasing portion of the bill of materials for our customers. DRAM and NAND TAM share of semiconductor industry has steadily grown over the last 2 decades from around 10% to approximately 30% today. The AI and 5G revolution is only in its infancy, and as these secular growth drivers gain further traction, we expect new data-intensive applications to continue to fuel significant increases in DRAM and NAND TAM. In the fiscal fourth quarter, data center revenue grew sequentially and year over year, fueled by secular drivers in cloud demand and the resurgence of enterprise IT investment linked to improving economic growth. Data center has become the largest market for memory and storage, driven by the rapid growth in cloud. With our broadening portfolio of differentiated products across memory and storage, we are in a strong position to drive strong growth and profitability in this important segment. We have been engaged on DDR5 from initial specification development and are well placed to support customer transitions to DDR5 enabled platforms starting later this calendar year. We are also enhancing our NVMe SSD portfolio and will soon introduce PCIe Gen 4 data center SSDs with Micron designed controllers and leveraging the full benefit of vertical integration. These SSDs will strengthen our market position over the course of the coming quarters and years in the fast-growing data center NVMe storage market. Work and learn from anywhere trends are driving a second consecutive year of double-digit PC unit sales growth in calendar 2021. In the fiscal fourth quarter, PC DRAM revenue was up significantly year over year. We are making strong progress transitioning our PC DRAM to our 1 alpha node, which represented a meaningful portion of our FQ4 PC bit shipments. Client QLC SSD bit mix hit a new record and made up the majority of our client SSD bit shipments in FQ4. Our QLC leadership enhances our bit supply capability and product profitability. We also have continued momentum ramping 176-layer NAND products for the PC market, and we qualified our 176-layer NAND-based Gen 4 NVMe client SSDs with several PC OEMs during the quarter. In graphics, revenue increased sequentially and year over year, driven by a continuation of last quarter's strong next-generation game console and graphics card shipments. Micron holds an excellent position in the fast-growing graphics market with a broad product portfolio featuring our proprietary GDDR6X product line and deep partnerships with leading GPU suppliers. FQ4 mobile revenue increased more than 25% year over year, driven by continued unit sales and content growth. We expect overall smartphone unit sales to grow this year, with sales of over 500 million 5G mobile phones forecasted. These content-rich 5G phones feature more than 50% higher DRAM and double the NAND content than 4G phones. We expect 5G and AI to drive new innovation in applications such as AI-optimized video capture and editing that will fuel DRAM and NAND content growth for years to come. Our 1-alpha LP4 16 gigabit design is now fully qualified and ramping at multiple OEMs, while our 176-layer NAND achieved its first UFS 3.1 qualifications at 2 OEMs. These wins demonstrate Micron's leadership in the mobile market and our continued strength in managed NAND products, where MCP sales surpassed $1 billion for the third straight quarter. We are continuing to see strong demand in our edge markets, which includes automotive and industrial IoT. We expect the automotive and industrial markets to be the fastest growing memory and storage markets over the next decade. As the number one player in these markets, Micron is exceptionally well positioned to benefit from these secular growth trends. Our automotive business delivered a fourth consecutive record quarter, driven by continued recovery in auto manufacturing and the growth of memory and storage content, driven by in-vehicle infotainment and driver assistance applications. Industrial IoT revenues also set records in the fiscal fourth quarter, benefiting from the continued growth of applications such as point-of-sales devices, factory automation, and surveillance. We expect industrial demand trends to accelerate further as 5G speeds the adoption of data-intensive applications powered by intelligent edge infrastructure. We are also seeing an acceleration in our consumer IoT business, driven by rapid growth in devices such as VR headsets, smart exercise equipment, and smart speakers. Turning to market outlook, calendar 2021 is shaping up to be a strong year. We expect calendar 2021 industry DRAM bit demand growth to be in the low 20% range and industry NAND bit demand growth to be in the high 30% range. Overall, our preliminary view is that calendar 2022 industry bit demand growth will be consistent with long-term industry bit demand growth CAGRs in the mid to high teens for DRAM and approximately 30% for NAND. We anticipate underlying demand in calendar 2022 to be led by increasing data center server deployments, 5G mobile shipments, and continued strength in automotive and industrial markets. Additionally, non-memory supply shortages that are constraining customer bills across various end market segments and that are pushing out some demand should ease throughout 2022, supporting demand growth during the year. Given prudent industry capex and very lean supplier inventories, we expect healthy industry supply-demand balance and robust profitability for both DRAM and NAND in the year. In the near term, our FQ1 bit shipments will decline modestly in both DRAM and NAND from very strong levels in FQ4. Some PC customers are adjusting their memory and storage purchases due to shortages of non-memory components within our supply chain for certain IC components, which will somewhat limit our bit shipments in the near term. Bit shipment growth will resume in the second half of the fiscal year, and we are planning to deliver record revenue with solid profitability in fiscal 2022. Our calendar year 22 bit shipment growth for DRAM and NAND will be in line with the industry. However, due to the strong shipments in fiscal year 21 and our below normal current inventory level, for fiscal year 22, our bit shipment growth for DRAM and NAND will somewhat lag the long-term CAGR. In fiscal year 22, the continued ramp of 1-alpha and 176-layer NAND should provide us with good front-end cost reductions. Our efforts to increase supply chain resilience and provide business continuity to our customers will cause headwinds to our assembly and packaging costs, consistent with the trend in the overall industry. Overall, we expect annual cost per bit reductions to be competitive with the industry in fiscal year 22 and over the long term. Turning to capital expenditures, we expect fiscal year 22 CapEx in the range of $11 billion to $12 billion. The year-on-year increase in CapEx is driven by our continued 176-layer NAND transition, pilot line enablement for next-generation NAND and DRAM, and continued infrastructure and prepayments to support the introduction of EUV. Fiscal year 22 DRAM equipment CapEx for manufacturing will decline from fiscal year 21 as we benefit from the capital efficiency of our mature 1-alpha node. For fiscal year 22, our bit supply growth will be achieved through node transitions alone, as we are a few years away from needing wafer start additions to keep up with the industry demand. We also expect to increase fiscal year 22 R&D investment by approximately 15% from fiscal year 21 to deliver bold product and technology innovations designed to fuel the data economy, as well as to expand our portfolio to capitalize on opportunities such as high bandwidth memory and CXL solutions. Our leadership portfolio, product quality, supply chain agility, and deep customer relationships make us a preferred partner in many of our markets, and we are confident in our ability to continue to create long-term, sustained profitability and returns built on that leadership. I will now turn it over to Dave.
Thanks, Sanjay. Micron delivered excellent FQ4 results, highlighted by our second highest quarterly revenues, strong gross and operating margins, and our substantial positive free cash flow. Total FQ4 revenue was approximately $8.3 billion, up 11% quarter over quarter and up 37% year over year. As a reminder, FQ4 of last year was a 14-week quarter and impacts our year-over-year comparisons. FQ4 revenue growth was broad-based with solid demand and price increases in both DRAM and NAND. Our robust growth in FQ4 contributed to strong performance in FY21 with revenue of $27.7 billion, which was up 29% from the prior fiscal year. FQ4 DRAM revenue was $6.1 billion, representing 74% of total revenue. DRAM revenue increased 12% sequentially and was up 39% year over year. Bit shipments increased in the lower single-digit percentage sequentially, and ASPs increased in the high single-digit percent range quarter over quarter. For the fiscal year, DRAM revenue increased 38% year over year to $20 billion, representing 72% of total fiscal year revenue. FQ4 NAND revenue was approximately $2 billion, an all-time high, and representing 24% of the total revenue. NAND revenue increased 9% sequentially and was up 29% year over year. Bit shipments increased by low single-digit percentage sequentially, while ASPs increased in the mid-single-digit percent range quarter over quarter. For the fiscal year, we achieved a new company record for NAND revenue of $7 billion, an increase of 14% year over year. NAND revenue represented 25% of our total fiscal year revenue. Now turning to our FQ4 revenue trends by business unit. Revenue for the Compute and Networking business unit was $3.8 billion, up 15% sequentially and up 26% year over year. Growth was led by the data center and graphics markets. Revenue for the Mobile business unit was $1.9 billion, down 5% sequentially and up 29% year over year. Mobile demand remained healthy in the quarter with continued momentum from the rollout of 5G. MBU revenue for fiscal 21 exceeded $7 billion and set a new record. Revenue for the storage business unit was $1.2 billion, up 19% from the prior quarter and up 32% year over year. Data center SSDs had strong growth in the quarter, driven by enterprise and cloud strength. QLC shipments set a new record in the fiscal year in terms of percentage of our NAND shipments. Finally, the embedded business unit generated record revenue of $1.4 billion, which was up 23% sequentially and more than doubled year over year. We continue to experience strong demand across the automotive and industrial markets. For the fiscal year, EBU revenue easily exceeded $4 billion, setting a new revenue record. The consolidated gross margin for FQ4 was 47.9%, up 500 basis points from the prior quarter. Pricing increases across DRAM and NAND, as well as strong execution in our ongoing product portfolio transformation, drove margin expansion in the quarter. Operating expenses in FQ4 were $891 million, on the lower end of the range we provided in last quarter's earnings call. FQ4 operating income was $3.1 billion, resulting in an operating margin of 37%, up from 32% in FQ3 and up from 21% in the prior year. FQ4 EBITDA was $4.7 billion, resulting in an EBITDA margin of 57.1%, compared to 53.3% in the prior quarter and 47.4% in the prior year. For the fiscal year, total EBITDA was $14 billion, up from $9 billion in the prior fiscal year, and represented 50.4% of revenues. Non-GAAP earnings per share in FQ4 were $2.42, up from $1.88 in FQ3 and up from $1.08 in the year-ago quarter. EPS included approximately 2 cents of gains from investments in our venture arm, Micron Ventures. For the fiscal year, total EPS was $6.06, up more than 100% from the $2.83 achieved in the prior fiscal year. Turning to cash flows and capital spending, we generated $3.9 billion in cash from operations in FQ4, representing 47% of revenue. For the fiscal year, cash from operations totaled $12.5 billion, up from $8.3 billion in the prior fiscal year. Net capital spending was $2 billion during the quarter and $9.7 billion in fiscal 21. We generated positive free cash flow of $1.9 billion in FQ4 and over $2.8 billion for the fiscal year. The increased cash flow was driven by strong revenue growth, increased profitability, and efficient working capital management. As Sanjay mentioned, we expect our fiscal 22 capital spending to be between $11 billion and $12 billion. Like fiscal 21, we expect our capital spending to be weighted more to the first half of the fiscal year, which will constrain free cash flow in FQ1 and FQ2. We do expect to generate healthy free cash flow in fiscal 22, but weighted toward the back half of the year. We also expect to close our Lehigh fab sale within FQ1, and we will receive approximately $900 million in proceeds from the sale. We completed share repurchases of $1.1 billion, or approximately 13.9 million shares in FQ4. For the fiscal year, we repurchased $1.2 billion, or approximately 15.6 million shares. From fiscal 17 to fiscal 21, we generated over $20 billion of free cash flow. During this period, we used approximately $5 billion of that cash flow to retire debt and $7 billion towards buying back stock and eliminating the dilution from convertible debt, reducing our share count by 148 million shares. We also improved our total cash and investment position by $5.5 billion. We expect that we will continue to generate strong free cash flow in the future, and as we discussed on our capital return strategy call in early August, we are committed to returning more than 50% of cross-cycle free cash flow to shareholders through a combination of buybacks and a quarterly dividend that we expect we can grow over time. The first dividend payment of 10 cents per share will be paid on October 18th to shareholders of record as of October 1st. The initiation of a dividend is an important milestone that reflects the structural transformation Micron has undergone over the last several years, and it shows our confidence in the sustainability of our cash flow generation. Our ending FQ4 inventory was $4.5 billion, and average days of the quarter were 94 days, below our normal range of 95 to 105 days. FQ4 finished goods dollar inventory ended at the lowest level since the Elpida acquisition in 2013. We ended the fiscal year with $10.5 billion of total cash and investments and $13 billion of total liquidity. Our FQ4 total debt was $6.8 billion. Now turning to our outlook. End demand across our major markets remains strong. As Sanjay mentioned, our bit shipments are expected to decline modestly in FQ1 as we normalize our inventory position and work with PC customers as they manage through their supply chain challenges. And on the gross margin side, our outlook is similar to how we viewed FQ4. While we will benefit from our node transitions on both DRAM and NAND, we will continue to see near-term headwinds from COVID-related expenses in assembly and packaging. As a result, we expect the gross margins in FQ1 to be largely a function of the mix. With all these factors in mind, our non-GAAP guidance for FQ1 is as follows. We expect revenue to be $7.65 billion, plus or minus $200 million, gross margins to be in the range of 47%, plus or minus 100 basis points, and operating expenses to be approximately $915 million, plus or minus $25 million. Excluding the impact of any potential new tax legislation, we expect our non-GAAP tax rate to be approximately 10% for FQ1. Based on a share count of approximately 1.14 billion fully diluted shares, we expect EPS to be $2.10, plus or minus 10 cents. In closing, fiscal 2021 was a year of considerable growth and success for Micron. Looking at four-year average metrics reveals the sustained cross-cycle performance of our business. Over the last 4 years, our gross margins have exceeded 40%, and our operating cash flow margins have been approximately 50%. Despite the challenges stemming from the ongoing pandemic, we have continued to generate significant positive free cash flow while making substantial investments to grow our business. Our technology, product, and financial position provide strong momentum as we enter the new fiscal year. I'll now turn it back to Sanjay.
Thank you, Dave. I would like to share a recent accomplishment that makes me especially proud of our company. Our strong Micron culture has played a significant role in driving our results aligned to our broader vision to transform how the world uses information to enrich life for all. Our company culture, community leadership, and business performance is being recognized globally, earning multiple industry awards and recognitions this year. This month, we were ranked by Fortune as one of the top 20 best places to work in manufacturing and production, the only semiconductor company to earn this recognition. Fiscal 21 was an excellent year for Micron. As our fourth quarter results clearly demonstrate, we are delivering strong financial results. We are planning to deliver record revenues and solid profitability in fiscal year 22. Demand for memory and storage is solid across market segments. Industry trends like the broad integration of artificial intelligence into all computing, proliferation of the intelligent edge, continued data center growth, and deployments of 5G networks create new and expanding opportunities for Micron. The importance of semiconductors to these markets is underscored by government initiatives to invest in domestic semiconductor production, both here in the U.S. through the CHIPS Act and in other countries around the world. We are focused on building our technology leadership to deliver bold new solutions that offer unique value to our customers. Our business is robust, and we are energized to seize the opportunities ahead of us at a truly exciting time in the semiconductor industry. We will now open for questions.
At this time, I would like to remind everyone, in order to ask a question, please press star 1 on your telephone keypad. Again, that is star 1 to ask a question.
Star 1? Yeah.
We have your first question from Harlan Sur with JP Morgan. Your line's open.
Good afternoon. Thank you for taking my question. You know, there are a lot of concerns on inventories in all of your end markets, especially PCs, just given the non-memory component shortages that are limiting notebook and desktop shipments in the second half of the year. Can you guys just qualitatively describe customer and channel inventories in PC, server, and smartphone segments of your business? And also, as you normalize your inventories to the first half of this fiscal year, do you guys anticipate normal level of inventories on your balance sheet as you enter the second half of the fiscal year?
So I will have Dave comment on the second part of your question. And on your overall inventory question, I would say that by and large, inventory among our customers is in decent shape. Of course, we talked about the PC market, where due to semiconductor component shortages, our PC customers, some of them, are not able to fulfill all of their end demand, and therefore they have made some adjustments in their purchases, impacting some of our demand in the near term into the PC market. And we think this is short-lived, and over the course of next few months, this will work itself out. And on the smartphone side, of course, you know that new phone launches are coming up, and this tends to be a seasonally strong quarter for new smartphone shipments as well. And while some customers may, because of geopolitical considerations or through the lessons learned during the pandemic or their own supply chain considerations or supply chain shortages, may be having a strategy of carrying more inventory than some other customers, overall, the smartphone market continues to be driven by 5G transition, smartphones over the course of calendar year 22 with 5G increasing by 50% from the 2021 levels. And on the data center side, of course, the investment cycle is strong on the data center side. And of course, the pandemic has driven a strong acceleration in digital transformation, and that's certainly extending into the cloud services, video streaming, e-commerce, all of these trends, along with new architectures, new processors that are being introduced that actually enable greater AI capability into the workloads and greater usage of greater attach of memory in the servers. All of these also are creating new demand. So overall data center inventory levels also in decent shape. So inventory in our markets today is in much better shape than it was back in the 2018 time frame. Again, some customers may have higher levels due to their strategic considerations, and they may choose to continue to do so in the longer term as well, given the challenges faced by the supply chains during the pandemic, as well as given geopolitical considerations. So this is what I would like to share with you on inventory. And Dave, you can add the second part of the question.
So just as a reminder, you know, when we look at our optimal level of inventory, we like to see it be 100 plus in terms of days. We can operate slightly below that. We are definitely below the optimal level at 94 days. I'd say the lowest we'd ever like to see it go is below 95 days. And so we think we will make a little bit of improvement next quarter in terms of days. It will probably be up a few days. But I think it's going to kind of be still below that 100-day figure. As we look through the year, it's, you know, assuming we can make some progress on inventory, we think we can get it more into what we would call the optimal stage, which is 100 to 105 days of inventory. Probably going to exit the year somewhere in the 100 days of inventory. As we already talked about, finished goods inventory is really where we're particularly lean, and you know, we do have to make some progress in that space to get ourselves into a better position. But overall, I'd say, you know, the back half of the year will probably be in the optimal range.
Yeah, thank you for the insights there. And you mentioned in your prepared remarks seeing constraints within your supply chain for certain IC components, which is going to limit some of your bit shipments also here in the near term. Can you just give us some examples of some of these IC components, both in DRAM and in NAND? I assume, for example, you have some NAND controller constraints, but what about in DRAM?
So Harlan, you're right to note that some of the controller shortages are there with respect to SSD, and particularly impacting the data center SSD. We also have certain shortages of analog ICs, and these kind of shortages are impacting our ability to ship to the full demand level that we are seeing from the customers. But if we look at controllers, some of the analog ICs, as well as in general, overall supply chain is running tight. And we have done a great job by our supply chain team in addressing these needs in the past, and they continue to work on securing the supply for the future, and we would expect that over time this will get better.
Thank you, Sanjay.
Thank you. Our next question comes from the line of C.J. Muse of Evercore. Your question, please.
Yeah, good afternoon. Thanks for taking the question. Was hoping to drill in into your gross margins. Pretty impressive despite the top line guide. So I guess a couple parts here. First, in terms of the cost down within the November quarter, I'm assuming more DRAM than NAND. Can you speak to that? Can you also speak to mix shift in the quarter? And then for all of fiscal 22, how should we be thinking about the type of cost downs across both DRAM and NAND? Should we, think 10+% is sustainable year on year for DRAM and, similar type number, if not higher on NAND, or how should we think about that? Thank you.
Okay, so let me start with the near-term outlook. I would say the cost declines for the November quarter are going to be pretty minimal. We obviously are getting a benefit from both our 1-alpha node and our 176-layer node in NAND, but we are running into some cost headwinds as it relates to the back end, mostly a function of the pandemic and the disruptions that's caused to the supply chain and so forth. And that's actually both a NAND and a DRAM comment, quite honestly. So no specific.
All right, 2/3 done.
DRAM and NAND. As it relates to mix, obviously, we have a range. It can go a couple of different ways, obviously. But there could be a little bit of a mix shift between DRAM and NAND that could impact where the gross margins end up. Also, by business unit, we could see some mix shifts within the business units, which could impact our margins as well, and even down to the product level. So it's hard to call within a couple hundred basis points, so that's why we gave this range. As I've mentioned in the prepared remarks, it's pretty similar to the range we gave. In fact, it's exactly the same as we gave in the prior quarter. So we're roughly seeing things pretty similarly to what we saw in the fourth fiscal quarter. And I agree with you. These are great gross margins. We're pretty happy with them. The operating margins that this generates is in mid to high 30s. We're expecting something similar for the first fiscal quarter. So we think we're executing very well on the profitability side of the business. On fiscal 22, we do expect really good cost declines on the front end side for both DRAM and NAND. Again, a function of 1-alpha in DRAM and 176-layer in NAND. When we look at kind of longer term cost declines for DRAM, we see them as being mid to high single-digit % cost declines for the industry. We think from a front-end perspective for DRAM, we'll do better than that next year. On the NAND front, we see cost declines over time being more in the mid-teens, and we think the 176-layer next year will drive cost declines in that range next year as well. Obviously, Q1, Q2 are will likely have these cost headwinds as it relates to the pandemic and the supply challenges. So those things, might impact us in the first couple of quarters. But hopefully, over time, that starts to go away, and we'll start to see the benefit also on the back end. We made a lot of investment on the back end to improve our cost structure, and I think once we get behind this, or get this behind us, I should say, as it relates to the pandemic, we'll start to experience a lot of the cost benefits that we've put in place on the back end as well. I'd also note that when we look at our cost structure today, and as we're looking into next year, all the way through the year, we think the cost reductions that we're seeing are very competitive with the industry. And the cost headwinds we're seeing are very similar to the cost headwinds that others within the industry, not only in memory but also across the entire semiconductor space, are seeing. So, we think this sets us up for, as Sanjay mentioned, very good profitability for next year. And I think that pretty much covers it.
Thanks, Ed.
Thank you. Our next question comes from Shannon Cross of Cross Research. Your line is open.
Thank you very much. The first question I had is with regard to pricing. Can you talk about some of the pricing dynamics, especially with the pullback in demand from the PC vendors? Are you expecting to see any more aggressive moves from your competitors? Although given your comments on gross margin, I'm guessing the answer may be no. And then my second question is just with regard to your PC OEM partners. How are you tracking confidence that they're going to actually see the demand come through in second half of the year? Because I get a lot of questions from people about double ordering, even just from their end customers. So I'm just wondering if you've changed any methodology in how you're tracking what your partners are seeing or how you're, providing guidance as you look out. Thank you.
So with respect to pricing, we do not provide, comments on pricing. But you can look at our FQ4 results, and of course, we reported that both for DRAM and NAND in FQ4, pricing increased. And you are right to note that our gross margin guidance for FQ1 is strong, in fact, same as Dave earlier pointed out, as our FQ4 guidance was at the time of our June call. As you look at not only just FQ1 for fiscal year 22, we are projecting a record year for the company with solid profitability for the full year as well. And just remember that pricing is always a function of the mix overall as well. And with respect to your questions around PC, again, as I mentioned, the PC customers have been impacted by their own semiconductor shortages and their supply chain constraints. Their end demand, their end user demand is very strong. In fact, they have unfulfilled backlog generally among these customers, which is quite extensive. And you know that even in the PC industry, while prices have gone up, if the customers are able to maintain a strong backlog, that speaks to the end strong demand. It really is all driven by work from home, learn from home. The demand acceleration that has taken place through the pandemic will continue to support healthy environment for PC in calendar year 22 as well. Of course, in 2020 and 2021, PC has gone through a double-digit unit growth on a calendar year basis. We expect that to moderate in calendar year 22 to perhaps from flat to low single-digit year-over-year growth in terms of PC units sold, yet it will be a healthy market. And again, driven by the trends such as with the economies opening, businesses opening, workers coming back, that drives a greater mix of enterprise PCs, commercial PCs. So while some of the consumer PC, such as Chromebooks, maybe compared to last year, maybe less in demand today, but the commercial PC demand is getting stronger as well. So overall, PC continues to be a healthy market, and we work closely with our customers. And today, they are really constrained by their supply chain shortages, and that's what is adjusting their purchases. And as I said before, we believe this is going to be short-lived, and we look forward to continuing to support our customers with our products. And as we highlighted, our new technologies, new products, 1-alpha transitions, PC customers are qualifying them fast, and we are focused on delivering those in calendar year 22 as well as fiscal year 22 timeframe.
Thank you.
Thank you. Our next question comes from Toshiya Hari of Goldman Sachs. Your line is open.
Hi, good afternoon. Thanks so much for taking the question. I was hoping you could provide a little bit more context around your fiscal 22 CapEx guidance of $11 to $12 billion. If you can kind of speak to WFE within that number for fiscal 22 and then differentiate between DRAM and NAND, that would be super helpful. And then just remind us what kind of bit supply growth are you expecting purely from transitions in both DRAM and NAND as you think about calendar 22? Thank you.
Okay, so maybe as I'll go through the CapEx for you. So as Sanjay mentioned, and as I reiterated, we expect CapEx to be in the $11 to $12 billion range. We were roughly a little bit less than $10 billion, $9.7 billion in fiscal 21. If you look at it by the elements of CapEx, we are going to invest more in pilot enablement this year. Last year was a relatively low year for us in terms of pilot enablement, so that's going to be a reasonable step up in our CapEx spending. We feel CapEx equipment in DRAM will be down year over year. We think we made a good investment in fiscal 21, and we don't need to invest as much in fiscal 22, so that will be down. NAND will actually step up pretty meaningfully in fiscal 22 versus 21. If you remember, we took CapEx way down in fiscal 20, goosed it up a little bit in 21. Now we're up to kind of a full investment level in 22 to support 176 layer. And that was caused because of this transition from floating gate to replacement gate when we made kind of a pause in terms of our CapEx investment to get the first line out at relatively minimal levels. Back end, we should be up a bit in back end spend as we continue to make investments on the back end to put that cost structure into better place, as I intimated before. We've been making investments to improve our cost structure there. Clean room will be down a little bit, modestly, and of course we have EUV spending that also will impact our CapEx in fiscal 22 as well. The one other thing, just to remind you, so we will be kind of like 60% of our CapEx kind of weighted to the first half, probably 40% in the second half. So this was similar to what we saw in fiscal 21. We're likely to see in fiscal 22, which is kind of our has been our typical pattern over the last couple of years.
And Dave, the transitions, you guys talked about calendar 22 bits growing mid to high teens on the DRAM side and approximately 30% on the NAND side in line with the industry. What portion of that growth are you guys expecting purely from transitions to 1-alpha and 176?
Yeah, sorry, I didn't forget that again. Yeah, so it's all from node transitions. We're not adding wafers. We don't see for the foreseeable future adding
10 years in a row raising their R&D.
Few years we
That's
might
what
be
we like
adding
to see.
wafers in DRAM, as Sanjay mentioned. But NAND, we think we can continue with node transitions to support the growth.
Thank you.
Anyway, let's finish.
Thank you. Our next question comes from Aaron Rakers of Wells Fargo. Your question, please.
Yeah, thanks for taking the question. I wanted to ask about, a little bit more about the end demand dynamic, particularly around the data center. I'm curious as we move forward, how are you thinking about the bit demand profile of the data center and the server market, and what are you seeing as far as kind of the progression of, the progression of memory to compute ratio as we move forward to next generation CPUs? I'm just curious at how you're rolling forward the expectations over the next year and that growth profile from a bit perspective.
So within the data center, both for DRAM and NAND, demand trends would be strong. In fact, data center today has become the largest market for DRAM and NAND and will continue to grow faster than the average of the industry, both for NAND and DRAM in the foreseeable future as well. So it's really being driven by the trend of AI driving greater need for memory in addressing data-intensive workloads. The BOM is going from about the memory and storage part of the BOM in the servers in data centers is going from about 30% few years ago to around 40% now and going to 50% in few years time frame as well. And new architectures, new processors are enabling more cores, and more cores means more memory attached per core, therefore greater gigabytes per server for DRAM as well as for NAND. DDR5 is a transition that will be occurring over the course of next couple of years as well as new CPUs get launched into production. And DDR5 is a higher bandwidth solution. It of course enables more value, higher performance in the applications. So that adoption will be going on, and over the course of the years, of course, CXL and HBM, these ultra bandwidth solutions, these will also be continuing to grow in the data center space. So average content per server for both DRAM and SSD will also be growing over 20% on a CAGR basis in each of these applications. So strong opportunity ahead, and Micron is very well placed with respect to our own product portfolio in terms of SSDs displacing HDDs, in terms of us providing higher density memory modules for server and data center applications. So as cloud gets bigger, the data center market gets bigger for us, and we are very well positioned. And this is an area we have focused on and continue to focus on expanding our product portfolio, particularly on the side of the data center SSDs. So we look at this as a strong growth opportunity for the industry as well as for Micron. The value that memory and storage solutions providing in this space is really critical for the services that our cloud customers are providing. And just keep in mind that enterprise as well, while it grows at a lower rate compared to the cloud, we are seeing a resurgence in enterprise applications as well, driving for overall healthy demand trends in data center in calendar year 22, fiscal year 22, as well as beyond.
Yep. And then as a quick follow-up, Dave, I'm just curious, as you start to, this last quarter, implement some share repurchases, how do you think about the liquidity on the balance sheet or managing the company from a cash on hand perspective?
Don't get attached to that.
Continuing to lean more in on share repurchase, just, how much cash do you need operationally to comfortably run the company?
So we roughly are holding about mid-30s as a percent of revenue in terms of liquidity. But $2.5 billion of that liquidity is our unused revolver. So cash is obviously less than that. We obviously have more liquidity than we need, which of course, is a good opportunity as it relates to the buyback. As I mentioned, we're also going to receive $900 million from the sale of our Lehigh fab. That also can be utilized for returns to shareholders. And we're expecting healthy free cash flow in fiscal 22 as well. And so, we'll be able to leverage that. We committed to return at least 50% of it in the form of dividend and buyback, mostly buyback. And we could obviously go higher than that. Our authorized plan, we still have $6 billion left in our authorized plan for repurchases. And, if we see the stock be weak, which of course is how we viewed it in the fourth quarter, we'll be aggressive about buying back stock.
Perfect. Thank you.
Thank you. Our next question comes from Joe Moore of Morgan Stanley. Please go ahead.
Great, thank you. I wonder if you could address, with transitions going on in both DRAM and NAND to 1-alpha and RG2, are there any issues that creates from a mix standpoint in terms of, it seems like there's quite a bit of demand for the older products, where are you in terms of getting qualified in the newer products? Just how is that affecting you guys?
Actually, we are doing very well with respect to ramping up these new nodes in production. Right on our plan. In fact, in terms of yields, ahead of our plan, I highlighted that the yields in these 176-layer NAND as well as 1-alpha DRAM have ramped 20 to 30% faster than our prior 1Z generation node and the prior FG node, the last FG node. So, and customer qualifications actually are going very well with these nodes as well. As I mentioned earlier, that we are already shipping our 1-alpha in the PC space, as well as broadening its shipments to other parts of the markets as well. In fact, customers are working closely with us in qualifying these products. One of our 176-layer NAND-based mobile product went from just introduction to 1 million unit shipments in a record time, fastest ramp in the history of the company. So overall, these nodes in production, as well as in terms of deployment in the market, are doing very well for us. And of course, this is all baked into our guidance that we have provided in terms of our revenue as well as our cost expectations.
Great. Thank you very much.
Thank you. Our next question comes from John Pitzer of Credit Suisse. Your line is open.
Yeah, thanks, guys. Thanks for letting me ask questions. Congratulations on the solid execution. Sanjay, you're sort of characterizing the current environment as relatively short-lived. Are we supposed to read into that as we go into the February quarter, your business might normally kind of buck normal seasonal headwinds? And I guess, importantly, upturns to date, this memory cycle has been very different than prior memory cycles. Typically, you have sort of 8 quarters of unabated ASP growth and margin expansion. We're kind of, at least plateauing here 3 quarters into it. What's different about this cycle, and I guess what makes you confident this is just a pause and not something more nefarious?
So with respect to the comment on the short-lived, just to be clear, what I was mentioning was that with respect to PC part of the market, where our customers, some of our customers in the PC market have experienced semiconductor shortages impacting their decisions on purchases of memory. That's what I was mentioning short-lived, because their end user demand on PCs is still very strong and lot of unmet demand that actually stretches the demand over time and makes the demand longer, stronger for longer. But my comment regarding short-lived and addressing it in the next few months was related to the PC part of the market. And outside of that, in other markets, as we discussed earlier, we see strong demand trends, strong end user demand trends, and of course, the supply chain shortages that are being experienced in PC are also being experienced in other parts of our markets as well by our customers, but of course, different customers are handling them in overall different fashion. But the underlying demand trends driven by AI and 5G, from data center to the intelligent edge to the user devices, are strong. They are secular in nature. COVID further accelerated it. Semiconductor supply chain shortages are only stretching that demand out because some of the demand gets pushed out. So as I said, making those demand growth drivers actually stronger for longer as well. So you can call it pent-up demand, but that's what I'm referring to. So on the demand side, things are here overall strong. On the supply chain aspects, of course, this is something that that the lead time in the semiconductors is long, and this will take several quarters to continue to improve. Parts of the semiconductor supply chain have already seen improvements. Our expectation is that these will continue to improve as well over the course of the coming quarters. And so, also keep in mind that our industry, the memory industry, over the course of last couple of years, has tapped into the inventory to ship beyond the supply growth. And this is a phenomena that has occurred across the industry. Certainly you have seen that how Micron has brought its inventory to the leanest level in many years, in fact below our target inventory levels. So this is something that is common to all suppliers in the memory industry. And as we look ahead, the supply growth will not only have to meet the customer requirements, but it will also have to replenish the inventory that has been taken to such low levels. Inventory has to be replenished in order to make sure that we are able to service our customers and meet their demand requirements, which from time to time change. So these are all factors as well. Very lean levels of inventory by the suppliers, as well as need to replenish that inventory, will drive for a healthy demand-supply balance in calendar year 22 timeframe as well. So yes, some of this, in terms of our own supply chain shortages and some that are being experienced by our customers, we expect to be addressed over the course of time. And some of these shortages on the semiconductor ecosystem may take through 2022 timeframe. By the end of 22, maybe some of them will be relieved. However, we expect them to continue to be improving through the course of time, all the way through calendar year 22. But the demand dynamics of the underlying strong drivers and the supply dynamics that I discussed, including the prudent capex investments that have gone on in the industry, and the lean supply, all of this will lead to healthy supply-demand environment in the industry. So it's really the combination of the demand drivers and the suppliers' supply capabilities and shipment capabilities. That combination, I think, really sets us up well as an industry for revenue growth and strong profitability in 22. And of course, we have projected, based on our expectations, that we will have record revenue in fiscal year 22 and solid profitability as well.
Sanjay, those inventory comments were very helpful. I'm just kind of curious as a quick follow-on. Your guidance for bits to be down in the November quarter, how much is that a conscious decision by you to hold bits off the market, to help maybe cushion pricing, and how much of that is just be driven by there's no demand for those bits and that's why bits is down?
Well, again, I think, keep in mind that our inventory is very lean. It is at the leanest level and below our target levels, and that is impacting some of our ability to meet the demand as well. And overall, our projection of bits with respect to FQ1 is really a function of our own supply chain capabilities in terms of where our inventory is and what we can ship at this point to the customers, certainly impacted by some of the component shortages, non-memory component shortages that we are seeing in the marketplace as well, and our assessment of overall demand. And the main thing there really is around the PC, where some of the demand is impacted. But overall, when you look at our guidance for FQ1, which takes into account any aspects of seasonality as well, but the guidance for FQ1 at its midpoint is about 32%, 33% higher than the same quarter last year. So, our inventory capability is also overall impacting some of the ability for our customers in terms of what we can ship.
Perfect. Thank you.
Thank you. Our last question comes from the line of Timothy Arcuri of UBS. Your line is open.
Thanks a lot. Appreciate that. Dave, I guess I had a question on gross margin. I wanted to go back to a question asked earlier. It's down only 100 basis points on your guidance on like an 8% down revenue quarter. And it sounds like bits are only down modestly in both DRAM and NAND. So it sounds like the delta is probably pricing, I would think, more on the DRAM side. And then, somebody asked you about costs, and you said, well, costs aren't coming down very much. So I guess I'm trying to figure out how gross margin is, so good. Is this going back to, some of the mix comments that you made last quarter? It seems like a more sustainable trend that maybe people are missing. So I'm wondering if you can kind of, flip that for us. Thanks.
Yeah, sure, Tim. So cost declines are going to be relatively muted. Remember that. There will be some mix changes that might impact gross margins to bring it down, somewhere within the range that we gave. Obviously, the rest is a function of pricing, and you have to infer what you can out of pricing. Obviously, if mix is the predominant factor in driving gross margins, pricing and cost will not be major factors in driving gross margins. Maybe that's the best way to say it.
Got it. Okay. And then I guess just last thing. So just on the cost curve, so you said you reached production crossover on 176 and on 1-alpha and 1Z. So how much, what's the lag effect in terms of when that really starts to bend the cost curve in a favorable direction, given that you've hit production crossover on those things?
Yeah, well, to be clear, 1-alpha and 1Z, we've hit crossover. 176 we hit at the end of the year. They're already, by the way, benefiting us from a cost perspective. It's hard to see it maybe as much, just because we're getting a little bit impacted, obviously, on the back end, which is impacting the cost declines. But next year, we do anticipate that both of them will drive good cost reductions for us on the front end side. So they will be good nodes for us in terms of cost structure, and I think we'll see that from a front end perspective every quarter. Again, I think the first couple of quarters It may not be as noticeable in our cost per bit calculations because of this, more of a headwind on the back end side of the cost structure. But after we get behind that, I think you'll see that show up on the cost per bit basis as well. The only other factor will obviously be mix as well, and we're going to drive like heck to get our mix to be a richer mix of higher value products, and which is always our goal. And of course, with higher value products, you get higher costs, but higher profitability, higher gross margins. So that's a good strategy, but that also kind of distorts the picture and will distort the picture over the course of the year as well.
Perfect. Awesome. Thank you.
Thank you. This concludes today's conference call. Thank you for participating. You may now disconnect.
Okay. Yeah, that one was close. I figured I'd play it out. So let's take a look at all of the assumptions I kind of put in here. I've got most of it sort of worked out. For revenue, I went -5% to 20%. You can kind of see their long-term CAGR. It's kind of been shifting up and down pretty rapidly for a 5-year rolling CAGR. It usually change so significantly year over year on that rolling number, but it's moving up and down from anywhere from 5% to 27%. So I think it's just assume that maybe they get another 20%, which is higher than the most recent 5 years. On the high end is reasonable, and then on the low end, we're actually assuming -5%, which basically assumes that the memory space becomes further commoditized, and that Micron actually has to push off a lot of its profits to other players. So I think that's a fine enough point to get. We get 7.5 as sort of a midpoint, which I think is a pretty reasonable assumption to have maybe for the next 5 years for them, which we kind of left that same for the analyst number here. Could argue that maybe the analyst number should be higher. It's plausible to argue. It doesn't really change the value all that much, partially because of other factors, but we'll go ahead and leave it there. That gives an expected CAGR of 8.5%. We are going to go look at the analyst numbers a little bit more closely in a minute, though. I'm already weighting the probability distribution a little bit more towards the positive end of things because of these negative outcomes I think are less likely, but I want to weigh them in just for the sake of weighing them in. And the same thing with the margins. Kind of assume that on the worst case scenario it does start to slide pretty significantly. You could argue this is a little bit too far. Maybe it should be 10% at the low end of things, and then 30 still feels a little bit high to be pushing that. Maybe if I leave the analyst number at 20%, that's fine. Still gets us a 20% margin expectation moving forward, which would still be a compression over time. So you could argue that. You could also argue that maybe this should be a little bit lower. I'm not sure. 28, 27. I don't know. We can go ahead and leave it there for now. We'll take a look at what the analyst numbers are in a minute. Returns on invested capital, that gets us an expected figure of 12.73%, which relative to the most 3 years is pretty in line with things. Their capital ratios is pretty low relative to what we were talking about. They have higher margins and low sales to capital ratio, partially because they have to make large investments in research and development in order to get the revenues that they want. Last 3 years, 0.53. So we're kind of assuming basically the same spacing for that, which is perhaps an undershoot of things because it was a little bit higher in the past prior to that. So you could argue that this is because they've been making the payments in the most recent years. In the next few years, they'll actually have a much better ratio than that. But this is still sort of where I'm going to go with it. Maybe I'd push the analyst down to 0.6 to give it a slightly larger boost. Debt ratios, they have a pretty low debt to ratio, so we basically assume they have to take on twice as much debt and that their market cap still compresses down a little bit. That gets us to possibly around 20% on the worst case scenario, which is basically doubling it with a little bit more. So that's how I get to that number there. And then 0 basically on the lower end of things, 10% being sort of the midpoint, because it's a distributed level of about 12%, which I think is a reasonable assumption to have. So that's all the assumptions except for the default risk. Oops, like I said, I want to adjust the revenue and margins a little bit after looking at the analyst numbers. Looking at their guidance, they also are guiding $7.65 billion, give or take $200 million in the first quarter of the next year. Which, if you just multiply that out, that gets you sort of an assumption of possibly around $30 billion In revenues, $31 billion, which gets us to these two right here, which is where we're weighting most of the outcomes, about 60% of them. So I feel pretty confident and fine with that set of assumptions as far as the revenue goes. For my own projections there, we'll take a look at what the analyst numbers are for that. Analysts are projecting next year to also be about $31.3 billion a year for that, $35.6 billion. That's 7 and 6 analysts respectively, with those CAGR rates. On Yahoo, we have 27 and 21 analysts respectively, which gets us, or 28 and 23 analysts respectively, my bad, which gets us an average of $32 billion and then $37 billion in the year after that. So it's a little bit higher on Yahoo, but they also have way more analysts, so it's possibly a better number to use. Their 5-year forward EPS rate, it seems to be 11.9% for Zacks, and then on Yahoo, they're getting us 21.93%. So if we just assume 10 to 20%, 15%, maybe in the midpoint there. Again, this is the analyst number, so we need to assume a little bit higher than this. It needs to be a little bit higher than this, maybe 11%, 12%. A little bit better. It's a little bit low in this level, but we don't really have a super great figure for what the projections are going to be for that. So I think this is probably fine enough assumption. 11% is still viable. 11 to 12 is basically what I would put in there, which makes me feel comfortable with these revenue assumptions. I like the analysts to usually fall between these two right there. If we go down to then the corrected net income without changing the net income margin, leaving it at 20%, that gets us an 8.82% CAGR for the net income, but that doesn't take into account share repurchases because this is net income, not EPS. So if EPS is going to go 11 to 20%, 15%, perhaps in the mid-range, with a lot of share buybacks in there, maybe 50% more, so you could assume 12 to 13% would be what it is. So you could argue that this still should go a little bit higher, 21, 22 maybe. Okay, that gets us 50% higher than that, gets us to about 15% in that range right there. So this would be in line with the analyst expectations, and it still puts us in between these two, which makes me happy. That does push up the overall expected return on average, but that's fine. If the analysts seem to think it's going to be reasonably positive, then we're weighing a little bit towards more negative outcomes. But either way, I like the balance of that. I'm not sure there's much else I want to do. I'm reasonably pleased with these sets of assumptions. Other guidance that they gave us, gross margin, I don't really pay too much attention to. I mostly just pay attention to income. I just pay attention to gross margin when I'm comparing, I guess, the strength of their brand, but not like an actual valuation do I even really pay attention to that. Operating expenses, we can kind of use this a little bit, and the diluted EPS, we can use that as well. Operating expenses, give or take, 915 million. We kind of have to think a little outside the box for this one, because if you 915 million, we're projecting about 31 billion, which gets us our 7.6 billion. 901 billion million, which would give you like 6 point something billion in net income. But that's the thing I'm a little confused on, is because that's operating expense for Q1, while the revenue is on that. The operating expense, because you have to take into account the interest expenses as well, which is the only thing that comes after the operating expense before net income. So I feel like they might be talking about the, I feel like they might be missing some of the operating expenses in here, or they're counting it differently, and I'm not 100% sure how they're counting it. This doesn't really seem to line up very well. But the EPS for $2.15 in the first quarter, if you can annualize that out, that gets you to $8.15 for the year. I don't know if that's actually going to be an accurate number or not, but if you just give it a multiple of 10, then that's a pretty decent return for the year already. We're currently flying at a multiple of 13.4 to 12, depending on if you use a P or a corrected net income P like I'm using. So 13 12 to 13, 12 to 13 on $8 EPS, then that still gets you $84 to $90 per share, which is incidentally pretty in range with what I've already got. So my point is that those numbers seem to be pretty well aligned. Also, they gave us the capex guidance for the whole year of 11 to 12 billion is their expected. If you look at what our reinvestment that we're expecting, sort of in the 4 billion range or so, but that's a netted reinvestment of like everything, so it's a little bit hard to read. But if you sort of just like look at the capex minus depreciation, that was like 4K right there. But you do have to take into account other things because it also includes the amortization expense for R&D versus the actual R&D. The 26 minus 21, which gets 500, plus 10 minus 6.2, which gets you like 4.8 to 5 or something, minus whatever the acquisition cost is, which is 0. So the point is I get 4 billion or so, but that does seem like it's not terribly far off from the capex of 11 to 12 billion based on the fact that that was a year of 10 billion. So I don't know, 5 billion is maybe what the number that they're expecting or whatever. So not terribly far off, but either way, I think that's all the assumptions. We can take a look at their default risk. Okay, so in the most recent year, they basically had no default risk. They also have $7.7 billion in cash on their balance sheet with a little bit less than 1 billion in marketable securities. So relative to the debt expectations that we have for their two best sets of outcomes, we don't really even have to think about debt default risk as even a problem. I'm only going to put that in for the first one. I suppose the second one's technically more iffy, so we'll just put it at the lowest default risk level. Then beyond that, we can just use whatever the formula comes up with, which is still really low. Okay, so basically no default risk. So that should do it. Well, make sure so that's coming through there. All right, so that'll be it. Ticker MU, Micron Technologies. Computer semiconductor memory player. Today the 10-year US Treasury is 1.58% with a mature market equity risk premium of 4.91%. Actually, you know what? Real quick, I need to update that. It is Monday after all. Okay. Raise expected return slightly. A little bit more. All right, that's about where we like to be. Okay, so the mature market equity risk premium today actually comes out to about 5%. Cool, it's made it over to the other spreadsheet. Yeah, so 10-year US Treasury, 1.58% with a mature market equity risk premium of about 5% today. I get to a discount rate for Micron of 7.85% after adjusting for company-specific risks. They currently have a dividend of 0.58%. They just started paying it. In fact, the very first quarterly payment of it comes out in like a week, although it's too late to actually qualify for it. But either way, that was one of the reasons I kind of decided to look at them today. I'm always excited when a company announces a new capital return plan, usually indicative of something. So either way, 5 years ago they had sales of $12.3 billion. In the most recent year, it was $12.7 billion, which is sales growth of 17.4% per year. So pretty strong for the 5-year period. Sales to capital ratio is 0.53, which is extraordinarily low than the industry expectations that we get of 1.26. However, as I was saying early on, I used basically the same formula mixing to come up with my beta as well as industry expected sales to capital and profit margins. And if I have to choose which one to make more accurate at the expense of one or the other, I usually go for the beta. So I think that that's especially the case in this one, that these sales to capital and profit margin expectations based on the industry are not really that meaningful here, unfortunately, because this would actually be a really good combination. But whatever. Sales to capital ratio for Micron of 0.53, with returns on invested capital of 12.39% in the most recent 3 years, which is pretty decent. Definitely higher than their cost of capital. The debt to equity ratio is 8.72%, so very little debt, and as a result they have basically no default risk. Their profit margins after adjusting for R&D costs comes to 22.99%, which is pretty decent, also higher than the industry expectations, but again kind of meaningless in this particular case. Their most recent year of profit, they had $6.4 billion, and that gets them today a selling price of $69.22 per share. On our valuation for the probability distribution, we're using a mostly standard distribution with it tilted slightly towards the fourth outcome out of the second outcome, so more towards the positive end of things, which gets us sales expectations of anywhere from $21.4 billion in 5 years to possibly a high end of $68 or $69 billion. Which gets us an expected revenue of $43.3 billion, which is growth of anywhere from -5% per year for the next 5 years, all the way to possibly a high end of 20% per year for the next 5 years. On an expected basis, we're assuming about 8.8%. Sales to capital ratio, we are expecting them to stay about the same, 0.53. And debt to equity ratio, we're assuming it goes up maybe slightly to 9.5%. Basically because they keep the same debt to equity ratios, they maintain basically zero default risk during the period, and their profit margins we're assuming compressed perhaps a little bit over the period down to about 20%, which is 21%, and this gets them an expected distributed profit of possibly about $9.4 billion in the 5-year forward year. And based off the discount rate that we're using for them, we get a present value price of $92.04. Which is a little under 33% less than the current price, so pretty undervalued. We have 5-year forward value targets, unadjusted for the dividends that they're going to pay out, of anywhere from $72.03 to possibly $266.86. We have, on a distributed basis, an expectation of a price of about $134.28, again, unadjusted for the dividends that they'd be paying out. Which, based off of the current price that they're selling at, that gets us an expected return for them of 14.17% per year for the next 5 years, which is pretty impressive. They're pretty undervalued on an absolute basis and pretty high return expectations on, again, an absolute basis. With decent profit margins and a decent overall position, they do actually end up with a pretty decent value score based off my own metrics for deciding what I want to buy. I get which is my own custom little scoring system. I get a score of 1.12 for them, which is pretty decent. If you look at the list of all the companies that we have valued in their value score listed on range, they range anywhere from 1.27 to negative 0.59, with the S&P 500 supposed to clock in at 0.6, and the average being 0.71, median of 0.79. So 1.12 is actually pretty decent. Not necessarily so much that I'm going to jump and buy it immediately, but it is pretty close. I would keep my eye on it. If it kept going lower, if it got down to 65, it might start to look even more appealing. If we got even closer to 60, it would probably start looking extraordinarily appealing. I don't know, hard to say when the jump point is, but I'll probably be keeping my eye on it. This is a decent opportunity. I did kind of skip over this section here. The short-term pricing metrics, pretty much on all across the board, seem to imply that it's a pretty cheap stock, which has partially to do with the high EPS analyst expectations. But those expectations, as I was just playing out, don't seem necessarily unreasonable, especially considering the buyback program that is in place for them. So this suggested price based on that $136 maybe is not too far off. Again, it's towards the high end of my 5-year forward value target, but perhaps some of these better outcomes is actually where we're headed. One thing I did want to point out though is that this the lowest value target for the 5-year forward period, which basically means if you hold it for 5 years, there's basically no chance of losing money. And in nominal terms, this doesn't adjust for inflation, but outside of the dividend that you're being paid per year, you would even still end up with about the same amount of money in the worst case scenario. There could be a decent amount of volatility in the short term because that would mean it's pretty undervalued today. But on the 5-year time horizon, this looks like an almost impossible to lose money scenario. Whether or not you make massive amounts of money is an entirely different question, but it does seem to have some decent possibilities for that. So the risk reward profile of this particular stock seems really good. That's basically the point I'm trying to say. The absolute risks or the absolute returns isn't necessarily the most amazing, but it's pretty decent. Like I said, I'm tempted. But I might wait to see if I can get the value score a little bit higher before making my initial jump. Partially because I've been jumping into a few new positions relatively quickly lately, so I'm trying to make sure that that doesn't get a little out of hand. But either way, very interesting stock, very decent quality brand in an otherwise somewhat commoditized space. So it doesn't look like they're overly commoditized. They've maintained their strong profit margins, and they've done a very good job of managing their capital. Their capital returns are very well managed. Their retained earnings are very well managed. Their research and development is very well managed, and their overall net reinvestment is very well managed. So that's almost tempting enough to buy for a lower value score. I honestly ought to upgrade the way I do my scoring system to maybe try to include some of those factors, but I haven't figured out a good way to measure those factors necessarily. But I'll have to give some thought on that. Either way, so this is Micron. Very interesting one to look at. Not sure what we're going to be looking at on Wednesday, or well, I do know what we're going to be looking at on Wednesday because we did already talk about my my little list, but I haven't actually looked at it since we last discussed it on Friday. So I just knew that I was doing Micron next today. I'm pretty sure it's something more foreign that we're doing next. I can't remember 100%. Or what? NIC? One's NIC? I can't even remember. Oh, okay, no, this is that nickel mine one. I'm pretty sure this is an Australian stock, but I'll have to see whether or not it actually has all the information available for me. You'll notice that that was a penny stock, so whether or not it's actually the one we'll be doing Wednesday is a little bit in question, but I'll be looking at that here shortly. So this is going to do it for live valuation today. And join us again around the market close on Wednesday if you enjoy in-depth financial analysis like this. Catch you all next time.